There is a fatal flaw at the heart of the modern financial system. It's a crack in the foundation of Wall Street, a weakness so profound and so structural that it creates an opportunity for the everyday person, the individual with a brokerage account and a dream of financial freedom, to consistently outperform the most brilliant minds in the game. This isn't a secret trick or a complex algorithm. It's an advantage you already possess. You were born with it. The only problem is that nobody has ever taught you how to use it as a weapon. They have spent decades convincing you that it's a liability. They have conditioned you to feel small, outmatched, and perpetually a step behind the professionals with their supercomputers, their exclusive access, and their armies of analysts. But it is all a magnificent illusion, designed to keep you playing a game you cannot win, while ignoring the one game where you are the undisputed champion. Warren Buffett, the man who built a $100 billion empire from the ground up, didn't do it by being faster or smarter in a conventional sense than everyone else. He did it by understanding this one fatal flaw and exploiting it ruthlessly for over 70 years. He understood that the greatest structural advantage in all of finance is not capital, not information, but time. The professionals are sprinters, forced to race from one quarterly earnings report to the next, their careers hanging in the balance every 90 days. You, the individual investor, have the privilege of running a marathon. They are judged on their performance this month. You have the power to judge your performance this decade. This difference, this gap in time horizon, is not just a small edge. It is everything. It is the arbitrage opportunity of a lifetime, available to anyone willing to shift their perspective. Today, we are not just going to talk about this advantage. We are going to deconstruct it, weaponize it, and build a new portfolio strategy around it. You will learn why the pros are trapped, how your patience is a superpower, how to change your mindset from a gambler to an owner, how to execute the difficult art of doing nothing, and how this all connects to the explosive, life-changing power of compounding. This is the blueprint for turning the tables on Wall Street. This is how you use your biggest advantage to win. Our journey begins by dissecting the very machine we're told to fear, Wall Street itself. To understand your advantage, you must first understand their weakness. It isn't a lack of intelligence or a shortage of resources. It is a prison built of their own success, a set of rules and incentives that forces even the most brilliant managers to behave in ways that are detrimental to long-term returns. This is the structural flaw, the crack in the system that we can drive a wedge into. And there is no better story to illustrate this institutional panic than a moment in 1963, when one of the most trusted companies in America was brought to its knees by a ghost, a con man, and an ocean of rancid salad oil. The company was American Express, a titan of finance, a symbol of American commercial might. Its core business was travelers' checks and credit cards, built on the unshakable foundation of trust. But a small, seemingly insignificant subsidiary of theirs, a warehousing division, had made a catastrophic error. They had issued warehouse receipts for millions of dollars worth of salad oil to a small company called Allied Crude Vegetable Oil. These receipts were used as collateral for massive loans from Wall Street banks. The problem was, the salad oil didn't exist. The con man at the head of Allied, a man named Tino DeAngelis, had filled his giant tanks mostly with water, with only a thin layer of oil floating on top. When the fraud was discovered, Allied collapsed instantly, defaulting on loans worth what would be over $1.5 billion today. Since American Express had guaranteed the receipts, Wall Street panicked. The consensus was immediate and brutal. American Express was on the hook for the entire amount. This, they concluded, would bankrupt the company. The stock, a blue-chip darling, plunged nearly 50% in a matter of weeks. The professionals, the hedge fund managers, the mutual fund titans, all rushed for the exits at once. Their logic was simple and deadly. Why hold on to a stock that could go to zero? The risk to their careers was immense. Imagine having to explain to your clients and your boss in the next quarterly report that you held on to American Express as it spiraled into bankruptcy over something as ridiculous as salad oil. It was unthinkable. The career risk, the fear of looking foolish in the short term, was far greater than the potential reward of being right in the long term, so they sold. They sold indiscriminately. They sold in a panic, and they sold at any price. But in Omaha, Nebraska, a young Warren Buffett saw not a crisis, but an opportunity. He wasn't constrained by quarterly reports or nervous clients. His only boss was his own reason, and his time horizon was forever. He refused to accept the market's verdict. Instead, he did the work. He started his investigation not by looking at a stock chart, but by observing reality. He went to restaurants. He stood in line at banks. He talked to merchants and travel agents. He was looking for the answer to a single question. Was the fundamental business of American Express, the business of trust in its cards and travelers' checks, being affected by the scandal in its warehousing division? What he found was the complete opposite of what Wall Street believed. Customers were still using their cards. Travelers were still buying their checks. The brand, the core franchise, was untouched. He then went deeper, analyzing the company's financials. He realized that even in a worst-case scenario, where American Express was forced to cover all the fraudulent loans, the company's immense earning power from its core business would allow it to survive and eventually thrive. The market was pricing in death, but the business was merely wounded, so he acted. Buffett took a staggering 40% of his partnership's capital, over $13 million, and plowed it into American Express stock. It was the single largest investment he had ever made. He wasn't just buying a stock, he was taking the other side of Wall Street's panic, a panic born from a structural flaw. Within 2 years, the stock had tripled, the salad oil crisis faded, the company's earnings recovered, and Wall Street eventually realized its mistake. Buffett's partners were made fantastically wealthy. The fund managers who sold in the panic had protected their careers in the short term, but they had sacrificed their clients' fortunes in the long term. They were forced to play one game, while Buffett, using his retail investor advantage of a long time horizon, was playing another. He won, not because he was faster but because he was slower. He won because he wasn't afraid of looking wrong for a quarter, or even a year, in order to be fantastically right over a decade. The behavior of the Wall Street professionals during the salad oil scandal wasn't irrational. It was a perfectly rational response to a flawed set of incentives, a response deeply rooted in two powerful psychological principles: myopic loss aversion and career risk. Understanding these is the key to unlocking the entire concept of time horizon arbitrage. Myopic loss aversion is a term coined by economists Shlomo Benartzi and Richard Thaler. It combines two separate concepts. The first is loss aversion, the well-documented fact that for the human brain the pain of losing is psychologically about twice as powerful as the pleasure of gaining. Losing $100 feels as bad as gaining $200 feels good. The second concept is myopia, which means short-sightedness. When you put them together, myopic loss aversion describes the phenomenon where the more frequently you check your investments, the more likely you are to see losses, and therefore the more pain you will feel, leading you to make overly conservative or panicky decisions. Imagine an investment that has a good chance of going up over the long run, but is volatile day to day. If you check it every year, you'll likely see a gain and feel good. If you check it every day, you are almost guaranteed to see frequent drops into the red. Each of those drops triggers that powerful pain of loss aversion. Now think about a professional fund manager. Their entire world is built around the quarterly reporting cycle. Every 90 days, they are judged. Their performance is scrutinized, ranked in league tables, and dissected by clients and consultants. They are living in a state of perpetual myopia. They don't have the luxury of not looking. Their frequent evaluation forces them to experience loss aversion on hyperspeed. A temporary 50% drop in American Express stock isn't an intellectual problem for them. It's a visceral, painful, career-threatening event that they are forced to confront and explain right now. This leads directly to the second principle: career risk. For a fund manager, the single greatest danger is not necessarily losing their clients' money in absolute terms. The greatest danger is underperforming their peers, their benchmark, for any meaningful length of time. A manager can lose money along with everyone else in a bear market and survive. But a manager who dramatically underperforms in a bull market or takes a bold bet that goes wrong in the short term will face redemptions. Their clients will pull their money, their assets under management will shrink, their fees will dry up, and they will be fired. This creates a powerful incentive to not stray too far from the herd. It's safer to be conventionally wrong with everyone else than to be unconventionally right by yourself, especially if that journey to being right involves a period of painful, lonely underperformance. This is one of the most potent hedge fund secrets. Their primary goal is not always maximizing returns. It's often minimizing career risk. Buffett's purchase of American Express was the epitome of career risk. He was making a massive, concentrated bet on a disgraced company that the entire world was selling. If he had been wrong, his fledgling partnership could have been wiped out, his reputation ruined. But he had no career risk in the institutional sense. His partners had entrusted him with their capital precisely because he thought differently. He had structured his business to give him the freedom to act on his best long-term judgment, free from the myopic pressures of the crowd. The retail investor has this same freedom, yet they so often voluntarily give it up, shackling themselves to the same quarterly mindset as the pros, checking their portfolios daily and feeling the amplified pain of every small loss. So how do you as an individual investor begin to systematically exploit this flaw? You need a practical mental model, a blueprint that allows you to diagnose market panic and separate genuine business problems from institutional forced selling. We can call this the institutional imperative test. It's a checklist to run through whenever a stock you own or are interested in takes a sharp dive. It's a way to put on your Buffett-colored glasses and see what he saw during the salad oil scandal. Step 1 is to identify the catalyst. What is the specific news or event that is driving the price down? Is it a missed quarterly earnings number? Is it a negative analyst report? Is it a broad market panic? Or is it news that fundamentally and permanently impairs the company's long-term earning power, such as a disruptive new technology from a competitor that makes their product obsolete? The key here is to differentiate between a temporary stumble and a permanent impairment. A quarterly earnings miss is often just noise. Wall Street analysts build intricate models predicting earnings down to the penny, and when a company misses by a few cents, algorithms and frightened managers sell automatically. This is a classic short-term reaction. Step 2 is to analyze the language. Go directly to the source. Read the company's press release and listen to the quarterly conference call with analysts. Are the executives talking about temporary headwinds, like supply chain issues or a one-time expense, while reiterating their confidence in the long-term strategy? Or are they evasive, announcing a fundamental shift in strategy because their old one is no longer working? Pay close attention to the questions the Wall Street analysts ask. Are they obsessing over the guidance for the next 90 days, or are they asking about the competitive landscape in the next 5 years? The analyst's myopia will often be a glaring signal of the short-term pressures at play. Step 3 is to investigate the selling pressure. Is the selling broad-based, or is it concentrated? You can use financial data services to look at institutional ownership. Or a few large funds, known for their high turnover, dumping their entire positions? This can be a sign of forced selling due to fund-specific rules or redemption requests. For entrepreneurs and those with a CEO mindset, this is like diagnosing a competitor's weakness. You're not just looking at the price, you're trying to understand the motivation of the seller. Are they selling because they have to, or because they truly believe the business is doomed? If they're selling because they have to, you're looking at a potential time horizon arbitrage opportunity. Step 4, and this is the most crucial, is to reevaluate the long-term thesis. Forget the last 24 hours of news. Go back to the fundamental reasons why you thought this was a good business in the first place. Does it still have a durable competitive advantage, a moat? Is its management team still rational and shareholder-friendly? Is its balance sheet still strong? If the answers to these questions are still yes, then a sharp price drop is not a signal to sell. It is a signal that the market is offering you the chance to buy more of a wonderful business at a cheaper price, thanks to the structurally enforced panic of the professionals. This test transforms you from a passive victim of market volatility into an active detective, using the market's short-sightedness as your primary clue. To truly appreciate the power of this approach, we must examine its opposite. We must walk the path of the 99%, the path most individual investors are coaxed onto by the financial industry. This is the path of mimicking the professionals, but with none of their resources and with even worse timing, a strategy destined for failure. The typical retail investor, let's call him Frank, doesn't see the structural flaws of Wall Street as an opportunity. He sees the professionals as gurus to be followed. He consumes financial news voraciously, believing that being more informed minute to minute will give him an edge. His portfolio strategy is reactive. He hears about a hot mutual fund manager who has had 3 great years in a row. He looks at the manager's stellar track record and, driven by a fear of missing out, he invests a large sum of his savings. What Frank doesn't realize is that he is likely buying at the peak of that manager's performance. He is chasing past returns, a classic and costly mistake. For the next year, the manager's strategy, perhaps focused on high-growth tech stocks, falls out of favor. The fund underperforms the market significantly. Frank, who checks his account balance weekly, feels the mounting pain of myopic loss aversion. He reads articles questioning the manager's skill. He sees his investment is down 15%, while the S&P 500 is flat. The pain becomes unbearable. He sells, locking in his loss, vowing never to trust that idiot manager again. He then looks for the new hot manager, the one who did well in the last year, perhaps a value-focused manager, and repeats the cycle. Frank is playing the professional's game, but he is always one step behind. He buys high after a period of good performance has already happened, and sells low after the pain of underperformance becomes too great. He is being whipsawed by the very short-term focus he is trying to emulate. He is paying for the illusion of professional wealth management without any of the actual benefits. His entire journey is a frantic chase, a constant reaction to noise. He doesn't have a long-term philosophy. He has a collection of recent emotional reactions. He is the perfect customer for the Wall Street machine, generating fees with his frequent trading and providing liquidity for the more patient investors on the other side of his panicked trades. He is in essence funding the long-term returns of the very people who have learned to ignore the noise he obsesses over. The tragedy is that Frank possesses the one tool that could guarantee him success, the ability to set a multi-decade time horizon and stick to it, but he discards it, choosing instead to compete in the 90-day sprint, a race he is structurally guaranteed to lose. The consequences of these two opposing approaches, the patient exploitation of time horizon arbitrage versus the frantic mimicry of short-term professionals, are not just philosophical. They have a direct, quantifiable, and massive impact on an investor's financial statements. The difference manifests directly in returns, taxes, and ultimately the final value of a portfolio. Let's start with the concept of tracking error. In the world of professional money management, this is a critical metric. Tracking error measures how much a fund's performance deviates from its benchmark, like the S&P 500. A high tracking error means the manager is making bets that are very different from the index. A low tracking error means the fund is basically hugging the index. From a career risk perspective, a high tracking error is terrifying. If your unconventional bets pay off, you're a hero. But if they don't and you dramatically underperform the benchmark, you're fired. This immense pressure to minimize tracking error forces many managers into becoming closet indexers. They charge high active management fees, but their portfolio looks remarkably similar to a cheap index fund. They are prevented from making the bold, contrarian long-term investments, like Buffett's American Express bet, that have a high tracking error in the short term but generate enormous wealth in the long term. This structural constraint puts a ceiling on their potential returns. As a retail investor, you have no benchmark but your own financial goals. Your tracking error is irrelevant. You have the freedom to be 100% different from the index, to make concentrated bets on your best ideas, and to hold them through periods of underperformance without the fear of being fired. This freedom is a direct financial advantage. It unshackles your portfolio strategy from the institutional imperative, allowing you to hunt for opportunities the professionals are too afraid to touch. Then there's the direct impact on the balance sheet. A patient, long-term investor who buys a great business and holds it for decades is engaging in one of the most efficient forms of wealth building. The value of their asset compounds year after year within the portfolio, tax-deferred. The growth isn't being constantly shaved down by taxes. Compare this to the high turnover strategy of the 99%. Every time they sell a position for a gain in less than a year, they are hit with short-term capital gains taxes, which are taxed at the same high rates as ordinary income. A significant portion of their profit is immediately confiscated by the government, dramatically reducing the capital they have available to reinvest. They are running a race with a parachute of taxes strapped to their back, while the long-term investor runs freely. The friction of taxes and trading costs, which seems small on any single transaction, compounds into a colossal drag on performance over time. The professional world is rife with these costs, and the retail investors who mimic them inherit the same disadvantage, creating a massive quantifiable gap between their potential returns and their actual take-home results. This is how the flaw in their system becomes a tangible number in your brokerage account. Once you have grasped the fatal flaw of Wall Street's short-termism, you can begin to cultivate its antidote. This antidote is not a complex financial instrument or a piece of secret information. It is the simple yet profound superpower of patience. Patience, in the context of investing, is not passive waiting. It is an active, strategic, and often difficult choice. It is the deliberate decision to operate on a time horizon that is fundamentally different from the rest of the market. It is a form of arbitrage where you are exchanging your willingness to endure short-term volatility and psychological discomfort for the prospect of superior long-term returns. It is the core of the retail investor advantage. To see this superpower in action, we must look to Warren Buffett's investment in the Washington Post Company in 1973. It is a masterclass in patient, long-term investing against a backdrop of extreme negativity. At the time, the Washington Post was not the celebrated institution it is today. The company had just gone public, and the stock had been hammered, falling by nearly half. The market was in a brutal downturn. Moreover, the paper was at the center of a political firestorm. Its reporters, Bob Woodward and Carl Bernstein, were aggressively pursuing the Watergate scandal, making powerful enemies all the way up to the White House. The Nixon administration was openly threatening the company, challenging the broadcasting licenses of its profitable television stations, which could have crippled the business. Wall Street's verdict was clear: the stock was toxic. The business was too risky, the political headwinds were too strong, and the newspaper industry as a whole was seen as being in decline. It was the last thing a professional, worried about their quarterly performance, would want to own. But Buffett, once again, saw a different picture. He looked past the terrifying headlines and the short-term market sentiment. He wasn't analyzing the next election cycle, he was analyzing the next several decades. He saw a business with a powerful, almost monopolistic competitive advantage. In a one-newspaper town like Washington, D.C., the Post was the essential source of information. It had pricing power with advertisers and a deep connection with its readers. He calculated that the entire company was being valued by the market at around $80 million. Yet he believed the company's assets, if sold off individually, were worth at least $400 million, and likely much more. He was able to buy $1 of pristine business assets for 20 cents. So in 1973, he invested nearly $11 million, acquiring more than 10% of the company. The CEO, Katharine Graham, was initially suspicious of this folksy investor from Omaha buying up her company's stock on the cheap. But Buffett wasn't a corporate raider, he was a long-term partner. He joined the board and became a trusted advisor to Graham for years. And then he did the most difficult thing in all of investing. He waited. He was patient. For the first few years, the stock did very little. A professional manager would have been fired for such stagnant performance. But Buffett wasn't a professional manager. He was a business owner. He held on. And as the years turned into decades, his patience was rewarded on a scale that is almost impossible to comprehend. The Watergate scandal, which seemed like a mortal threat at the time, ultimately solidified the Post's reputation for journalistic integrity, strengthening its brand. The company's earnings grew, and the power of compounding began to work its magic. That initial $11 million investment, held patiently for over 30 years, grew to be worth over $1.5 billion. It was more than a 100-fold return. It was the kind of wealth building that creates dynasties. It was a return that was utterly inaccessible to anyone forced to think in 90-day increments. It was a victory made possible only by the superpower of patience. The reason most people fail to harness this power, the reason they sell a Washington Post in 1975 instead of holding it until 2005, lies deep within our brain's wiring. The psychological principle at play is called hyperbolic discounting. It's a fancy term for a very simple and very human tendency. We have a strong preference for immediate rewards over larger rewards that come later. Our brains are, in a very real sense, hardwired for instant gratification. This makes perfect evolutionary sense. For most of human history, the future was deeply uncertain. It was far more rational for our hunter-gatherer ancestors to eat the food they found today, rather than save it for a winter that might never come. A bird in the hand was worth far more than two in the bush, because the bush might be struck by lightning tomorrow. This ancient wiring remains with us today, and it creates a powerful cognitive bias against long-term investing. The entire financial ecosystem is designed to exploit this bias. The constant stream of breaking news, the livestock tickers flashing red and green, the daily market summaries. It's all a siren song calling us to act now. The pleasure of locking in a small, quick gain is immediate and tangible. The pain of watching a stock drop today is sharp and real. In contrast, the potential reward of a massive gain 20 years from now is abstract, distant, and difficult for our brains to process emotionally. This is hyperbolic discounting in action. The value of that future reward is discounted so heavily in our minds that it feels less valuable than the smaller, immediate emotional payoffs of acting today. Patient investing, therefore, is an act of rebellion. It is a conscious decision to override our primitive brain. It requires us to engage our prefrontal cortex, the more modern, rational part of our brain, to suppress the impulsive, emotional demands of our limbic system. It's not the natural state of things. It requires training, discipline, and a strong belief system. Every time you choose not to sell during a panic, you are winning a battle against millions of years of evolution. Every time you add to a position in a great company while others are fleeing, you are exploiting a psychological flaw that is as predictable as it is powerful. The professionals on Wall Street are just as susceptible to this bias as anyone else, but their institutional structure pours gasoline on the fire. The quarterly performance reviews, the pressure from clients for immediate results, it all shortens their decision-making horizon, forcing them to capitulate to their hyperbolic discounting bias. They are incentivized to take the small, certain reward of career safety today over the larger, uncertain reward of superior returns a decade from now. Your advantage as a retail investor is your ability to structure your life and your portfolio in a way that starves this bias. You can choose not to look at your portfolio every day. You can choose to measure your success in 5-year increments, not 5-day ones. You can free yourself from the tyranny of the immediate and allow the true, slow magic of wealth building to unfold. To make this rebellion practical, you need a tool, a mental model that forces you out of the present moment and into the long-term future. This blueprint is called the 5-year test. It is a simple but profoundly effective exercise to be performed before you buy a single share of any company. It's a commitment device that shifts your entire investment psychology from that of a speculator to that of a strategic business partner. Here's how it works. Before you execute a trade, You must sit down with a blank piece of paper or a new document and physically write out the answer to this question. Why will this company be a significantly larger, more profitable, and more durable business in 5 years than it is today? This isn't about the stock price. It's not about what you think the market will do next quarter. It is a detailed, evidence-based thesis about the business itself. Your answer should be specific. It should touch on the company's products or services. Is there a clear path for growth? Are they expanding into new markets? It should analyze their competitive advantage, or moat. What protects them from competitors? Is it their brand, their network effects, their low-cost production? It should include an assessment of the management team. Do they have a track record of smart capital allocation? Are their interests aligned with shareholders? You need to write this out in clear, simple language. If you can't articulate a compelling 5-year thesis for the business, you have no business owning the stock. You are simply gambling. Step 2 of the model is the commitment. Once you have written this thesis and are satisfied with it, you make a pact with yourself. You will not sell this stock for at least 5 years, based on stock price volatility or broad market sentiment alone. The only reason you are allowed to sell is if your original 5-year thesis is proven to be fundamentally broken. For example, if a new competitor emerges and genuinely dismantles the company's moat, or if a new management team comes in and starts making irrational, value-destroying acquisitions. This transforms the act of selling from an emotional reaction into a rational, thesis-driven decision. The 5-year test accomplishes several critical things. First, it forces you to do the upfront research required for true value investing. Second, it creates a powerful psychological anchor. During the next inevitable market panic, when your emotional brain is screaming at you to sell everything, you can pull out this document and reread it. It acts as a circuit breaker, reminding your rational brain of the long-term reasons you invested in the first place. Third, it completely reframes your relationship with time. You are no longer concerned with the next 5 days of news. You are focused on the next 5 years of business execution. This simple exercise is a powerful piece of investment psychology. It is the practical application of patience, a tool for building the discipline required for beating the market over the long run. The antithesis to this disciplined, patient approach is the frenetic world of the day trader, the modern speculator who represents the path of the 99%. This is the individual who believes that the secret to wealth building lies in constant activity, in being faster and nimbler than everyone else. Their reality is a stark illustration of the disastrous consequences of abandoning the superpower of patience. Let's call this investor Tina. Tina starts her day before the market opens, scanning pre-market movers and reading news headlines. Her screen is a dizzying array of charts with moving averages, RSI indicators, and Bollinger Bands. She believes these patterns hold the secret to short-term price movements. She has a Robinhood account on her phone and checks it dozens, if not hundreds of times a day. Her portfolio strategy is a series of short-term bets. She might buy a tech stock in the morning because of a positive rumor she saw on a stock-picking forum, with the intention of selling it for a 2% gain by the afternoon. She might short a retailer that she thinks will have a bad earnings report. She is not investing in businesses, she is betting on the wiggles of a ticker symbol. This approach is the polar opposite of patient investing, and it is doomed to fail for a multitude of reasons. First, the transaction costs are immense. Every trade has a bid-ask spread, and even with commission-free trading, these small costs add up to a significant drag on performance. More importantly, the tax implications are brutal. Any gains she makes are short-term and taxed at her highest marginal income tax rate, often slicing her profits by a third or more. She is in a constant battle against friction. Second, she is playing a game where she has a massive structural disadvantage. She is competing against institutional high-frequency trading firms with billion-dollar algorithms, direct data feeds, and servers located right next to the stock exchange's matching engine. They can execute trades in microseconds. Tina, with her consumer-grade internet connection, is like a person on a bicycle trying to compete in a Formula One race. She will always be the last to react to new information. Finally, and most importantly, the emotional toll is devastating. Living in a constant state of high alert, reacting to every flicker of the market, leads to decision fatigue, anxiety, and burnout. It forces her to make emotional decisions, selling out of fear at the bottom of a dip, or buying into a FOMO-driven rally at the very top. She mistakes the adrenaline rush of activity for the quiet satisfaction of progress. She is working incredibly hard, but her net worth is going nowhere. She has taken her greatest advantage, the freedom to be patient and think long-term, and voluntarily traded it for the greatest possible disadvantage, competing on speed against supercomputers. The direct financial connection between patience and wealth is not a matter of opinion, it is a mathematical certainty. The impact on a portfolio is stark, quantifiable, and grows exponentially over time. Let's illustrate this with a simple, powerful example. Consider two investors, both starting with $10,000. Investor A is our patient, long-term investor. She uses the 5-year test. She identifies a high-quality company that she believes can reliably grow its earnings and compound its value at an average rate of 10% per year. She buys it and holds it for 30 years, doing absolutely nothing. She adds no new money. Investor B is our active, impatient trader. He also starts with $10,000 and invests in the same company. But he tries to be clever. He tries to time the market. When the market panics every few years, he sells, hoping to avoid the downturn, and when things feel safe again, he buys back in. History shows that this is an almost impossible task. The market's best days often occur in close proximity to its worst days, during periods of extreme volatility. Studies by firms like Fidelity have shown that if an investor missed just the 10 best days in the stock market over a 20-year period, their total return would be cut in half. Let's be generous and say that our impatient investor, Investor B, by jumping in and out, trading frequently, paying higher taxes, and missing a few of the best recovery days, manages to earn an average of 7% per year on his money, 3 percentage points less than the underlying company's return. At the end of year one, the difference is small. Investor A has $11,000. Investor B has $10,700, a mere $300 difference. Investor B might even feel smart, having, quote, avoided some volatility. After 10 years, the gap widens. Investor A, the patient one, has nearly $26,000. Investor B has just under $20,000. The difference is now $6,000, more than half of his initial capital. This is where most people give up on patience, because the reward doesn't yet feel life-changing. But now, the magic begins. After 20 years, Investor A has $67,000. Investor B has $38,000. The gap is now nearly $30,000. After 30 years, the final result is staggering. Investor A, the patient investor who simply bought and held, has a portfolio worth over $174,000. Investor B, the active trader who tried to outsmart the market, has just $76,000. The patient investor has more than double the wealth, a difference of nearly $100,000, all from that initial $10,000 investment. This difference is the quantified financial value of patience. It is the tangible reward for overriding your hyperbolic discounting bias. It is the mathematical proof that your time horizon is not a soft, philosophical concept, but a hard-edged financial tool that, when wielded correctly, becomes the single most powerful engine for achieving financial freedom. To truly weaponize your time horizon, you must undergo a fundamental shift in identity. You must stop thinking of yourself as someone who buys and sells stocks, and start thinking of yourself as a part owner of a collection of businesses. This is not a semantic game. It is a profound psychological reframing that changes every decision you make. It is the transition from being a speculator to being an owner, from having a gambler's mentality to adopting a CEO mindset. The pivotal moment in Warren Buffett's own evolution as an investor came in 1972 with the purchase of See's Candies. Before See's, Buffett was a pure cigar-butt investor, following the teachings of his mentor, Benjamin Graham. He looked for statistically cheap companies, often mediocre businesses trading for less than their liquidation value. He was buying stocks, not businesses. See's Candies changed everything. It was a wonderful family-owned California-based chocolate company. It wasn't statistically cheap by Graham's metrics, but Buffett's partner Charlie Munger pushed him to recognize that it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. They weren't just analyzing the balance sheet, they were analyzing the business. They saw a company with a fanatically loyal customer base and a powerful brand. This brand gave C something magical: pricing power. They could raise the price of their chocolates every year without losing customers. This was a moat that didn't show up on a spreadsheet. Buffett and Munger negotiated directly with the C family to buy the entire company for $25 million. During this process, Buffett wasn't thinking about where the stock would trade next year. He was thinking about the business. How can we expand? How do we protect the brand? What are the long-term prospects for the chocolate industry? He was thinking like an owner because he was becoming one. After the purchase, See's became a cash-generating machine for Berkshire Hathaway. The profits it produced were used to buy other businesses, fueling Berkshire's growth for decades. Buffett often says that See's Candies taught him the power of investing in quality brands. But the deeper lesson was one of mindset. The act of buying the whole company, of being responsible for its long-term stewardship, permanently rewired his brain. From that point on, even when he was buying a small piece of a publicly traded company like Coca-Cola or American Express, he approached it with the same mentality. He wasn't buying a stock, he was buying a piece of a business that he intended to own indefinitely. This is the mindset shift that every individual investor must make. When you see yourself as a part owner, the daily fluctuations of the stock market become what Buffett calls Mr. Market, a manic depressive business partner who shows up every day, offering to buy your shares or sell you his, often at ridiculous prices. On some days he's euphoric and offers you far more than your shares are worth. On other days he's terrified and offers to sell you his shares for a fraction of their true value. An owner doesn't let this manic partner dictate their actions. They use his moods to their advantage, politely declining his high offers and eagerly accepting his low ones, all while focusing on the long-term performance of the actual business. This shift from speculator to owner is powered by a psychological principle known as the framing effect. This cognitive bias demonstrates that the way information is presented to us, or framed, has a massive impact on the decisions we make, even if the underlying facts are identical. For example, people are more likely to support an economic policy if it's framed as having a, quote, 95% employment rate than if it's framed as having a, quote, 5% unemployment rate, even though these two statements describe the exact same reality. The framing changes our emotional response and, consequently, our choice. In investing, the default frame is that of speculation. The language of the financial world is filled with it. Playing the market, making a trade, stock picking, beating the street. The tools we use reinforce this frame. The stock ticker, a real-time feed of price changes, encourages us to focus on just that, the price. This frame activates a certain part of our brain, the part associated with short-term risk, reward, and competition. When you are buying a stock, your primary concern is what other people will pay for that stock in the near future. You are focused on market sentiment and price momentum. Now let's consciously reframe the activity. Instead of, quote, buying a stock, you are taking an ownership stake in a business. Instead of stock picking, you are engaged in business analysis. This new frame activates a completely different set of mental circuits. Your focus shifts from the stock price to the business fundamentals. You start asking different questions. As an owner, you're not concerned with what Mr. Market thinks today. You're concerned with the company's return on invested capital over the next decade. You're not worried about the next quarter's earnings. You're focused on the company's long-term competitive strategy. This reframing is not just a mental trick. It is a powerful tool for emotional regulation. During a market crash, the speculator, seeing the price of his stock plummet, feels panic. His asset is shrinking. The owner, seeing the price of his ownership stake decline, feels something entirely different. He knows the underlying business is still producing the same products, serving the same customers, and generating the same cash flow as it was yesterday. The price has changed, but the business has not. This frame allows him to detach from the market's hysteria and view the price drop not as a loss, but as an opportunity to increase his ownership stake in a fine business at a more attractive price. By consciously choosing your frame, you can architect your own psychological environment, making it far easier to practice the patience and discipline required for long-term investing success. For entrepreneurs, this mindset should be second nature. You would never judge the value of your own private business based on a hypothetical, volatile daily quote. You should apply that same owner's logic to your public market investments. To operationalize this ownership mindset, you need a concrete mental model that forces this perspective. This blueprint is the private buyer test. It is perhaps the single most powerful question you can ask before making an investment, and it is a cornerstone of true value investing. The question is this: if I had enough money to buy this entire company at its current total market valuation, and I was not allowed to sell it for at least 10 years, would I still make this purchase? This question is a powerful filter that instantly eliminates the vast majority of speculative temptations. It forces a complete and radical shift in perspective. First, it forces you to think in terms of the whole business, not just a single share. Instead of thinking about buying one share of Apple for $170, you are forced to contemplate buying all of Apple for its market capitalization of nearly $3 trillion. The sheer scale of the number forces you to be serious. You are no longer making a small bet. You are making a monumental capital allocation decision, just as a CEO would. Second, the buy the whole company frame forces you to look beyond the stock price and deeply into the business fundamentals. You would never spend $3 trillion without understanding every facet of the business: its revenue streams, its profit margins, its competitive landscape, its management quality, its culture, and its long-term growth prospects. You would have to develop a well-reasoned thesis for why this entire enterprise is worth the price tag. You would be forced to do the real work of business analysis. Third, the no sell for 10 years clause is the crucial element that injects the long time horizon directly into the decision-making process. It makes all short-term market fluctuations, all quarterly earnings noise, and all analyst upgrades or downgrades completely irrelevant. Your only concern is the likely state of the business a decade from now. Will it be earning more money? Will its competitive moat be wider? Will it be a better business? If you can't confidently answer yes to those questions, then you must not make the investment, even in a single share. Applying the private buyer test is a rigorous exercise. It requires work. It means you will make far fewer investment decisions. You might only find 1 or 2 companies a year that pass this stringent test. But the decisions you do make will be of infinitely higher quality. You will be building a portfolio not of stocks but of ownership stakes in wonderful businesses that you understand deeply and believe in for the long term. This is the path to moving beyond the frantic noise of the market and into the calm, rational, and highly profitable world of the business owner. The antithesis of the owner is the speculator, the individual who represents the path of the 99%. The speculator's mindset is a tragic blend of ignorance and arrogance, and it is the fastest route to financial disappointment. This is the person who buys a stock knowing only 2 things about it: its ticker symbol and the direction its price has been moving recently. Let's imagine this person, Greg. Greg hears about a company called QuantumScape from a friend who says it's the next Tesla, a revolutionary battery company. He doesn't read the company's financial reports. He doesn't know who the CEO is. He has no idea who their competitors are or what the technological hurdles are to creating a commercially viable solid-state battery. All he knows is that the ticker, QS, has gone up a lot, and he feels the acute pain of having missed out. He sees a flurry of hype on social media, with rocket ship emojis and confident proclamations of a squeeze that will send the stock to the moon. Driven by greed and a fear of being left behind, he buys a large position near the peak of the mania. For a few days, he feels like a genius as the stock continues to rise. He is not an owner, he is a passenger on a hype train. He has no underlying thesis about the business. His only thesis is that someone else will be willing to pay a higher price for his shares in the near future, the greater fool theory. Then, inevitably, reality sets in. The hype fades. The company announces delays in its research. A negative report from a short seller raises questions about its technology. The stock begins to plummet. Greg, who has no grounding in the business's fundamentals, has nothing to fall back on. He has no 5-year test document to consult, no private buyer test thesis to reassure him. All he has is a rapidly declining stock price. His emotional brain takes over completely. The euphoria of the ride up is replaced by the sheer terror of the ride down. He sells, locking in a catastrophic loss, blaming market manipulation or the shorts for his misfortune. He never acknowledges that the true fault was his own. He failed to do the work. He chose to be a speculator, a gambler, instead of an owner. This story has played out countless times, from the dot-com bubble to the meme stock craze. It is the predictable outcome of a mindset that treats the stock market like a casino. The speculator is focused only on price, while the owner is focused on value. And over the long run, price always, eventually, converges with value. The speculator is perpetually surprised and wiped out by this convergence, while the owner profits from it. The direct financial connection of adopting an owner's mindset is profound. It fundamentally changes the metrics you focus on, which in turn leads to a vastly different portfolio strategy and superior long-term wealth building. A speculator is obsessed with price-based metrics, price-to-earnings ratios, daily trading volume, and technical chart patterns. These are all reflections of market sentiment. An owner, on the other hand, is obsessed with business-based metrics, the vital signs of the enterprise itself. The most important of these is return on invested capital, or ROIC. ROIC measures how efficiently a company's management is at allocating capital to profitable projects. A company that can consistently generate a high ROIC, say above 15%, is a compounding machine. It means that for every dollar the company retains and reinvests back into its business, it generates 15 cents of new annual profit. A speculator might see a company's stock drop 20% after it announces it's retaining all its earnings to build a new factory instead of paying a dividend. The speculator sees the lack of an immediate cash payout and sells. The owner, with their CEO mindset, investigates the ROIC of the new factory. If the projected return is high, they are thrilled. They understand that reinvesting capital at a high rate is the fastest way to grow the intrinsic value of the business. They would rather the company keep the dollar and turn it into $1.15 of value than receive the dollar themselves as a dividend, which would then be taxed. This focus on ROIC leads you to own a very different type of company. You will gravitate towards businesses with deep competitive moats that allow them to sustain high returns on capital without competition eroding their profits. This is the essence of value investing in high-quality enterprises. Furthermore, the owner's mindset changes your behavior during market downturns. When the price of your ownership stake falls far below your assessment of its intrinsic value, your financial calculus changes. You don't see a loss. You see an anti-dilution event. You have the opportunity to increase your percentage ownership of this wonderful compounding machine at a discount. While the speculator is panic selling to cut their losses, the owner is calmly, or even enthusiastically, buying more, lowering their average cost and increasing their future returns. This single behavioral difference, selling versus buying during panics, is one of the largest determinants of long-term investment success. It is a direct financial consequence of the psychological frame you choose to adopt. The speculator is a leaf in the wind of market sentiment. The owner is the tree, rooted in the solid ground of business value. Once you have adopted the owner's mindset and cultivated the superpower of patience, you arrive at the most challenging phase of execution, the art of doing nothing. In a world that glorifies action, speed, and constant engagement, the deliberate choice of inactivity can feel unnatural, even irresponsible. Yet, for the long-term investor, it is often the most intelligent and profitable action one can take. Activity is not the same as progress. In investing, more often than not, it is the opposite. The quintessential story of brilliant inactivity is Warren Buffett's investment in Coca-Cola. He made his major purchase in 1988, investing over $1 billion to acquire a significant stake in the company. He had followed the company for decades, but was finally compelled to act after the stock market crash of October 1987 made the price attractive. His thesis was simple: Coca-Cola was one of the most powerful brands in the world, a simple business to understand, with a global distribution network that was almost impossible to replicate. It was a wonderful business. But the true genius of the Coca-Cola investment was not the purchase, it was the holding. After buying the stock, Buffett essentially did nothing for the next 3.5 decades. He has famously said that his favorite holding period is, quote, forever. Consider what he held through. He held through the Gulf War in the early 90s. He held through the Asian financial crisis. He held through the dot-com bubble, where Berkshire Hathaway was derided as an old-fashioned relic as tech stocks soared. He held through the bursting of that bubble. He held through the September 11th attacks. He held through the 2008 Great Financial Crisis, a cataclysm that brought the global banking system to its knees and saw his own net worth plummet by tens of billions of dollars. He held through the European debt crisis. He held through the COVID-19 pandemic and the global shutdown that followed. Through all this turmoil, all this panic, all this noise and chaos, he did nothing. He let the business do the work. He let Coca-Cola continue to sell its products around the world, to raise its dividend year after year, and to reinvest its profits to grow. The result? His initial $1 billion investment has paid him billions upon billions in dividends alone, and the value of his stake has grown to over $25 billion. A speculator would have sold a dozen times over. They would have sold in 1999 because tech was the future. They would have sold in 2008 because the world was ending. They would have sold in 2020 because restaurants were closed. At each of these moments, acting would have felt like the smart, prudent thing to do. But Buffett understood that these were temporary storms passing over a deeply rooted and unshakable business fortress. His inactivity was not negligence. It was the highest form of discipline. It was the ultimate expression of confidence in his original thesis, a masterclass in the art of doing nothing. The powerful urge to act, even when it's counterproductive, is driven by a deep-seated psychological impulse known as action bias. This is our innate tendency to favor action over inaction, especially in situations of ambiguity or uncertainty. When faced with a crisis, our brains scream at us to do something. Sitting still feels like surrendering control. Taking action, any action, provides an illusion of agency and helps to alleviate the anxiety of the unknown. Think of a soccer goalie during a penalty kick. Statistically, their best strategy is to stay in the center of the goal, as a significant percentage of kicks are aimed there. However, goalies almost always dive to the left or the right. Why? Because the pain of conceding a goal after standing still feels far worse than conceding a goal after making a dramatic, albeit unsuccessful, dive. The dive is action. It shows effort. Standing still feels passive. Action bias is rampant in investing. A market crash is a moment of profound uncertainty. The financial news is a torrent of terrifying headlines. Your portfolio value is shrinking. The pressure to do something, to sell, to rebalance, to change your strategy is immense. Selling, even at a loss, provides a feeling of relief. It stops the bleeding. You have taken control. The problem is that this feeling of control is an illusion. By acting on your panic, you have very likely just made the worst possible financial decision, selling a quality asset at a low price. The discipline of long-term investing is a continuous battle against this action bias. It requires you to be comfortable with the discomfort of uncertainty. It requires you to have a predefined system that prevents you from making emotional decisions in the heat of the moment. This is a core tenet of investment psychology. You must recognize that in many cases your desire to trade is not a rational response to new information about the business you own, but rather an emotional response to price volatility and a need to quell your own anxiety. The most successful investors are not the ones who act the most, but the ones who act the most decisively and correctly at a few critical moments, and then have the fortitude to do nothing for long periods in between. They have mastered their own action bias. They know that sometimes the most productive thing you can do for your portfolio is to go for a walk, read a book, or take a nap, letting your well-chosen businesses continue their slow, steady work of compounding value. To fight this powerful bias, you need a pre-committed plan, a behavioral circuit breaker. This blueprint is the inactivity checklist, a simple step-by-step process to follow whenever you feel the overwhelming urge to sell during a market panic. It's designed to pull you out of your emotional, reactive brain and engage your rational, analytical brain. Step 1. Unplug from the machine. The very first thing you must do is turn off the source of your anxiety. Close the stock market app on your phone. Turn off the financial news channel. Stop scrolling through social media feeds about the market. The constant influx of negative information is designed to trigger your fight-or-flight response. You cannot make a rational decision while you are in a state of panic. Give yourself a 24-hour cooling-off period where you consume no financial media at all. Step 2. Reread your original thesis. Pull out the document you created for the 5-year test or the private buyer test. Read, out loud if it helps, the specific, business-focused reasons why you invested in this company in the first place. This act re-anchors your mind to the long-term fundamentals, pulling your focus away from the short-term price chaos. Remind yourself that you are a business owner, not a speculator. Step 3. Ask the critical question. Now, with your original thesis fresh in your mind, you must ask one question. Based on the news that is causing this panic, has the long-term, multi-decade earning power of this business been permanently and catastrophically impaired? Be honest and ruthless in your answer. The 2008 financial crisis did not permanently impair Coca-Cola's ability to sell beverages. The COVID-19 pandemic did not permanently destroy Apple's brand or its ecosystem. A missed quarterly earnings report almost never permanently impairs a great company. If the answer to the question is no, then the checklist leads you to Step 4. Step 4. Do nothing or buy more. If the long-term thesis is intact, then selling is the least rational thing you could do. The correct course of action is either to do absolutely nothing and wait for the storm to pass, or, if you have the capital and the fortitude, to view this as an opportunity to increase your ownership stake at a discounted price, as dictated by your owner's mindset. You are only permitted to consider selling if you can honestly answer yes to the critical question in Step 3. If a disruptive new technology has truly made your company's product obsolete, for example, the inactivity checklist provides a structured, logical process that replaces emotional reactivity. It gives you something to do, the act of going through the checklist itself, which helps satisfy your action bias, but it channels that energy into a rational process that almost always leads to the correct conclusion. That disciplined inactivity is the most powerful move you can make. The path of the 99% is the polar opposite of this disciplined inactivity. It is the path of the active investor, the tinkerer, who believes that their constant attention and frequent trading will lead to superior results. They mistake activity for achievement and control for competence. Let's call this investor Dave. Dave prides himself on being on top of the market. He has alerts set up for all the stocks in his portfolio. A news story breaks, and his phone buzzes. He immediately logs into his brokerage account to assess the situation. He has a complex portfolio strategy involving dozens of different stocks because he believes in diversification. But in reality, he has created a portfolio he can't possibly keep up with. He is a master of what Peter Lynch called diversification. Dave is also a firm believer in protecting his capital, so he sets tight stop-loss orders on all his positions. He might set a stop-loss at 10% below his purchase price. The problem is that a 10% drop is just normal market volatility for many stocks. So a great company he owns might have a temporary dip, his stop-loss gets triggered, and he is automatically sold out of his position. He has protected himself from a small temporary loss, but he has also locked himself out of the subsequent recovery and all future long-term gains. He sold a wonderful business for a foolish reason. Dave also loves to take profits. When a stock he owns has a quick run-up, say 20% in a few months, his action bias kicks in. He feels the urge to do something, to make that paper gain real. So he sells, patting himself on the back for his savvy trade. What he has done is cut his flowers and watered his weeds. He has sold one of his best-performing businesses, and will likely reallocate that capital to a new, less promising idea. The Warren Buffetts of the world build their fortunes by riding their winners for decades. Dave ensures he will never have a big winner by constantly cutting them down in their infancy. The cumulative effect of this constant tinkering is disastrous. Dave's portfolio is a revolving door of positions. He incurs high transaction costs and, even more damagingly, a massive tax bill from all his short-term gains. He is perpetually busy, stressed, and engaged, yet his portfolio performance significantly lags a simple, boring index fund. He has fallen for the great illusion of the financial industry. That activity is the key to success. He has forsaken the art of doing nothing, and, as a result, has guaranteed his own mediocrity. The financial cost of this hyperactivity versus disciplined inactivity is not trivial. It is a massive, quantifiable drag on wealth building that manifests directly on your bottom line. The most obvious cost is in transaction fees. While many brokers now offer commission-free trades, the bid-ask spread is a hidden cost on every single transaction. It's the small difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. When you trade frequently, you are constantly crossing this spread, giving up a small slice of your capital to market makers on every round trip. Over hundreds of trades, this adds up to a significant sum. But the most devastating financial connection is taxes. The tax code is overwhelmingly biased in favor of the long-term investor. In the United States, if you hold an asset for more than 1 year, any profit you make is considered a long-term capital gain. These gains are taxed at preferential rates, which for many people are significantly lower than their income tax rates. If you hold an asset for less than 1 year, your profit is a short-term capital gain, taxed at the same high rates as your salary. Let's imagine our hyperactive investor Dave. He makes a $10,000 profit on a stock he held for 6 months. If he's in a moderate federal tax bracket, he could easily lose $3,000 to $4,000 of that profit to federal and state taxes. He is left with only $6,000 or $7,000 to reinvest. Now consider our patient investor, who also has a $10,000 gain but has held the stock for 2 years. When she finally sells, her gain is taxed at the long-term rate. She might only pay $1,500 in taxes, leaving her with $8,500 to reinvest. She has a huge tax-advantaged head start on her next investment. But the true power comes from not selling at all. By practicing the art of doing nothing, you allow your investments to grow year after year, decade after decade, in a tax-deferred environment. This is the equivalent of the government giving you an interest-free loan on what you would have paid in taxes. That untaxed capital continues to work for you, compounding on itself, creating a virtuous cycle of growth. The hyperactive trader is constantly interrupting this compounding process, sending a chunk of his capital to the government with every successful trade. He is fighting with one hand tied behind his back. The patient investor unleashes the full, uninterrupted power of compounding. This isn't a small detail. It is the master key to serious wealth building. The simple act of doing nothing is one of the most powerful tax avoidance and wealth creation strategies that exists. We have now arrived at the summit, the ultimate reason why this entire strategy is worth the discipline and psychological fortitude it requires. We've explored the flaws of Wall Street, the superpower of patience, the mindset of an owner, and the art of inactivity. All of these pillars serve one grand purpose: to unlock the explosive, world-altering force of compounding. Compounding is the engine of financial freedom, the mechanism by which small sums of money, given enough time, can grow into fortunes. And the single most important ingredient for that engine is a long, uninterrupted runway of time. The best story to illustrate this is not a single investment Warren Buffett made, but the story of his own life and his own net worth. It is the ultimate testament to the power of a long time horizon. Warren Buffett is one of the richest people in the world, but the vast majority of his wealth was not created in his youth or middle age. It was created in his old age. His wealth accumulation was not a straight line. It was a dramatic, exponential curve, a perfect illustration of compounding. Let's look at the numbers. Buffett started investing as a boy. By age 30, he had accumulated his first $1 million, an impressive feat. By age 52, after decades of brilliant investing, he was worth around $376 million. A huge sum, but not yet world-changing. But then, the curve began to steepen. By his 60th birthday, his net worth had ballooned to $3.8 billion. By his 70th, $29 billion. By his 80th, $45 billion. And by his 90th birthday, it was over $80 billion. The staggering fact is this: over 99% of Warren Buffett's net worth was earned after his 50th birthday. More than 95% was earned after his 60th. Think about that. His first 50 years of investing, which were legendary in their own right, created only a tiny fraction of his ultimate fortune. It was the subsequent decades of uninterrupted compounding on that already large base that created the truly mind-boggling wealth. This is the payoff. This is the final promise. Had he been a professional fund manager forced into retirement at 65, he would have been remembered as a brilliant, wealthy investor. But he would not have become the legend he is today. His greatest structural advantage was not just his skill, but his longevity and his lifetime commitment to his strategy. He gave his investments an unparalleled runway of time to work their magic. His life story is the ultimate rebuke to short-term thinking. It proves that the big money is made not in the buying or the selling, but in the waiting. It is the final, irrefutable evidence that a long time horizon is not just one tool in the toolbox, it is the entire workshop. The reason we so often fail to grasp the power that created Buffett's fortune lies in another flaw of our mental software: exponential growth bias. Our brains evolved in a world of linear relationships. If you walk for 1 hour, you travel a certain distance. If you walk for 2 hours, you travel twice that distance. It's simple, intuitive, and linear. But compounding doesn't work that way. It works exponentially, and we are notoriously bad at intuitively understanding exponential growth. When we see a chart of a compounding investment, our linear thinking brain projects the early, slow growth forward and gets discouraged. The first 10 years of Buffett's career produced good, but not magical, results. The process feels disappointingly slow at the beginning. This is the danger zone. This is where most people give up. They abandon their patient investing strategy because it doesn't provide the instant gratification their brains crave. They get impatient, they start trading, they chase get-rich-quick schemes, and in doing so, they constantly reset the clock on their compounding journey. They never allow their portfolio to reach the steep part of the exponential curve where the real magic happens. Imagine a pond where a single lily pad doubles every day. On day 1, there's 1 pad. On day 2, there are 2. On day 3, 4. For the first couple of weeks, the pond still looks mostly empty. Even on day 29, when the pond is half full of lily pads, an observer might think there's still plenty of time. But on day 30, the entire pond is covered. The growth in that final day was equal to all the growth that had come before it. This is how compounding works. The last few doublings of your investment portfolio will create more wealth than all the previous doublings combined. Understanding this exponential growth bias is critical to staying the course. You must have faith in the mathematics of compounding, even when your intuition tells you it's not working fast enough. You must accept that the first decade is the price of admission you pay to be present for the explosive growth of the third and fourth decades. Resisting the urge to interrupt this process is the final and most crucial psychological battle the long-term investor must win. To make this abstract concept of exponential growth tangible, we can use a simple but powerful mental model known as the double-up rule of 72. This is a quick mathematical shortcut that allows you to visualize and feel the power of compounding over your own investing lifetime. The rule is simple. To estimate how many years it will take for your investment to double, you just divide the number 72 by your expected annual rate of return. For example, if you expect to earn a 10% average annual return on your portfolio, it will take approximately 7.2 years for your money to double. 72 divided by 10. If you expect a more conservative 7%, it will take about 10.3 years. Now, let's use this blueprint to map out a 40-year investment career, from age 25 to 65, assuming a 10% average annual return. Let's say you start with a modest $25,000. According to the rule of 72, your first double will take about 7.2 years. So, around age 32, your portfolio is worth $50,000. A nice gain, but not yet life-changing. Your second double happens around age 39. You now have $100,000. This is a significant milestone. Your third double occurs at age 46, bringing you to $200,000. Your fourth, around age 53, takes you to $400,000. Your fifth, at age 60, brings you to $800,000. Notice how the numbers are starting to get big. Now for the final double before retirement. At age 67, your portfolio is worth $1.6 million. Let's pause and analyze this. Your first double created $25,000 of wealth. Your last double, in that same 7.2-year period, created a staggering $800,000 of wealth. It's the same time period, the same rate of return, but the outcome is exponentially different. This is the lily pad effect in action. This simple exercise makes the abstract concept of compounding visceral. It allows you to see how the real wealth is created in the later stages of the journey. It provides the intellectual and emotional fuel needed to stay patient during those early, slow years. It's a roadmap that shows you why it is so critical to start early and, most importantly, to never, ever interrupt the process. The antithesis of this patient, compounding-focused approach is the pervasive and destructive get-rich-quick mentality. This is the mindset of the 99%, a frantic search for shortcuts that ultimately leads to a dead end. This is the person who is not planting an oak tree that will grow for a century, but is instead desperately searching for a winning lottery ticket. Let's call him Kevin. Kevin is intelligent and ambitious, but he lacks patience. He sees the slow, steady path of value investing as boring and antiquated. He wants results now. So he embarks on a journey of strategy hopping. He starts by day trading, convinced he can outsmart the market with technical analysis. After a few months of stress and mixed results, he gives up. Then he hears about the fortunes being made in cryptocurrency. He dives in head first, buying obscure altcoins based on social media hype. He experiences a thrilling bull run and feels like a genius, but then gets wiped out in the subsequent crash. Shaken, he moves on to the next hot thing, trading options. He's drawn in by the promise of massive leverage and quick profits. He has a few wins, which fuels his overconfidence, but then a single bad bet blows up his entire account. From there, he might chase penny stocks, foreign exchange trading, or some other exotic strategy that promises outsized returns in a short period. Kevin's journey is a series of sprints that lead nowhere. He is constantly restarting his compounding clock at zero. He never allows any single strategy to work for long enough to see the benefits. He is like Sisyphus, the figure from Greek mythology doomed to eternally roll a boulder up a hill, only to have it roll back down each time he nears the top. The get-rich-quick mentality is the ultimate enemy of wealth. It is a siren song that preys on our hyperbolic discounting and our exponential growth biases. It promises a shortcut, but delivers a scenic route to failure. The sad irony is that the slow, boring, patient path of buying and holding wonderful businesses for decades is the most reliable and, in the end, often the fastest way to get truly rich. Kevin, in his desperate search for speed, has chosen the longest and most painful path of all, a path that almost never leads to the destination of financial freedom. Let's bring it all together and draw the final, direct financial connection. Let's quantify the staggering difference between a portfolio built on time horizon arbitrage and one managed with a short-term, high-turnover mindset. We will create two hypothetical portfolios, A and B. Both start with $100,000 and have an investment horizon of 30 years. Portfolio A belongs to our patient investor. She adopts the full Buffett Munger approach. She uses her time horizon advantage to buy wonderful businesses at fair prices, often during times of market panic. She is an owner, not a speculator. She does the art of doing nothing, letting her businesses compound uninterrupted. Because she buys quality and holds for the long term, let's assume she achieves an average annual return of 12% before taxes. Because she rarely sells, her tax drag is minimal. Let's say it reduces her effective return to 11% per year. Portfolio B belongs to our active, impatient investor. He mimics the behavior of the 99%. He chases hot stocks, panics during downturns, and trades frequently. He is constantly paying transaction costs and, more importantly, short-term capital gains taxes. His hyperactivity creates a significant drag on his performance. Let's assume the underlying assets he trades could have also produced 12%, but due to bad timing, taxes, and fees, his actual take-home return is only 8% per year. A 4 percentage point difference. It doesn't sound like much, but let's run the numbers. After 30 years, Investor B, our active trader, will see his $100,000 grow to $1,007,000. A respectable sum, to be sure. He has become a millionaire. But now look at Investor A, our patient owner. Her $100,000, compounding at 11% for 30 years, grows to $2,289,000. She has more than double the wealth of Investor B. The difference is over $1.2 million. This is not magic. This is math. That 4 percentage point gap, the patience premium, was the difference between a comfortable retirement and generational wealth. This is the direct, quantifiable, life-altering financial consequence of everything we have discussed. It is the dollar value of exploiting Wall Street's fatal flaw. It is the profit generated by your superpower of patience. It is the return on your owner's mindset. It is the reward for mastering the art of doing nothing. It is the final explosive payoff of unleashing the uninterrupted power of compounding. You have just been given a powerful mental tool. You have absorbed a framework that demystifies the market and exposes the single greatest structural weakness of the professionals you're told to fear. You now understand that your ability to think in decades while they are trapped in quarters is not a disadvantage. It is a superpower. You have learned how to weaponize patience, how to adopt the mindset of a business owner, and how to harness the discipline of inactivity to unlock the pure, explosive force of compounding. You have acquired the model of time horizon arbitrage, and it is the key to turning the tables on Wall Street and building lasting, meaningful wealth. But what you've mastered today, as powerful as it is one crucial node in a much larger network of interconnected mental models. The system of thinking that built empires like Berkshire Hathaway is not a single idea, but a latticework of principles. Knowing when time to hold a great business is a game changer. But how do you identify a great business in the first place? How do you calculate its intrinsic value to know when the price is a bargain? How do you construct a portfolio and manage your own psychology to withstand the inevitable storms? Mastering the when is only part of the equation. The next step is to master the what and the how. The video that is now appearing on your screen is not an accident. The algorithm has identified it as the next logical piece of this complex puzzle. It is the link that connects the strategy you've just learned to the next level of execution. It is the next section of the blueprint, the next piece of the map that leads from where you are now to where you want to be. Most people will stop here. They will feel satisfied with this new knowledge and move on. But those who are truly committed to this journey, those who possess the genuine CEO mindset, understand that learning is a compounding process in itself. They know that each new model they acquire strengthens all the others. The choice is yours. You can stop here, with one powerful weapon in your arsenal, or you can continue your ascent. You can choose to forge the next link in the chain, to complete your understanding, and to build an unshakable foundation for your financial future. The path to doing that is right there. Click and continue to build your mental arsenal.